Greetings, everyone. Welcome to the Liberty Call. It is Monday, January 30th, 2023. Also have the weekly economic update we're going to cover today, and not a fantastic day in the markets. Lots of red on my screen, but we got the Fed meeting, tomorrow and Wednesday. And then, everybody's freaking out about what the Fed's going to do and how that's going to, affect the markets. We'll see. They keep claiming that we're going to have that soft landing into the, as inflation comes down. But I don't know. I think we might have another bout of higher inflation rising. But, again, I read a lot of different sources and a lot of different people, and a lot of people have a lot of different opinions. So anyway, so if it's your first time watching the Liberty Call, please give me some thumbs up, likes, shares, subscribes. I would greatly appreciate it. Send it off to some friends, family, or people you think might get something out of my ramblings here, for 10 or 20 minutes most days after the market closes. So, all right, let's go ahead and take a look and see how the market finished up today. The Dow Jones wound up being down 0.77%, closed at 33,717. S&P 500 was down 1.27, closed at 4018. NASDAQ down almost 2%, 1.96%, closed at 11,393. Small caps are down 1.44. The VIX was up today 7.51%. It's currently holding at 1990. About to go back over that 20 number that, again, if you watch this on a regular basis, you know that anything below 20 is your green light from a volatility risk perspective. When the VIX gets from 20 to 30, that's kind of your yellow light warning. Gets over 30, in my opinion, that is your red light. Proceed with caution. All right. The other indexes here in the Americas, Canada was down 0.69, Brazil down 0.24, Mexico down 0.42. Hopping across the Atlantic, Germany was down 0.16, UK up 0.25%. France was down 0.21, Euro Stoxx was down 0.46, Netherlands down 0.78, Spain down 0.12, Italy down 0.38, Switzerland up 0.42, and Portugal down 1.02%. Russian exchanges were split. MOEX was up 0.69, RTSI down 0.5%. And the overnights in Asia, looks like everything was open again today after last week's Lunar New Year or whatever it is that the Chinese New Year. I'm not sure exactly which one it was, but Japan was up 0.19% last night. Australia down 0.16%. The Chinese markets, lots of green. The Shanghai was up 0.14. The SESE component up 0.98. China A50 up 0.76. DJ Shanghai up 0.2. The Hang Seng down 2.73. And the Taiwan weighted up 3.76%. All right, so that's everything as far as the markets over trading day, January 30th. Had to think. Anyways. All right, well, let's go ahead and dive into this week's weekly economic update and see what they had, what I had to say. So, all right, the week on Wall Street, stocks added to their early 2023 gains amid a busy stream of mixed corporate earnings results and conflicting economic data. The Dow Jones Industrial Average gained 1.81%, while the S&P 500 added 2.47%. NASDAQ rose 4.32%, and internationals increased by 1.14%. Stocks advanced with the backdrop of earnings reports and conflicting economic data. Stocks climbed higher on cooling inflation, continued economic resilience, and fourth quarter corporate earnings results that, while underwhelming, did not appear as bad as many had feared. There was enough new economic data to support both the, quote, recession is coming, end quote, and the, quote, in quote, soft landing camps. It was corporate results and continued labor market strength, along with a solid, if weakening, fourth quarter GDP growth numbers. However, that raised investors' hopes that a potential recession may be mild and likely push out to later in the year. Again, if you believe that, I got a bridge I can sell you in Arizona. GDP report. The U.S. economy expanded at a 2.9% annualized rate in the fourth quarter, slightly exceeding consensus estimates of 2.8%, but down from the third quarter's 3.2% growth rate. Consumer spending, which accounts for over two-thirds of GDP, rose 2.1%. Increases in private inventory investment, government spending, and non-residential fixed investment also contributed to the fourth quarter's growth. Weakness in housing and a drop in exports subtracted from the quarter's result. Beneath the headline number, the Personal Consumption Expenditures Price Index, the Fed's preferred measure of inflation, rose 3.2%. That was lower than the third quarter's 4.8% increase, though it remains above the Fed's 2% inflation target. This week, we have economic data coming out on Wednesday. First up, we have the FOMC committee announcement. They'll announce what will happen with interest rates. Most people seem to guess it's going to be of 0.25% raise, but, could be higher. The job openings and turnover survey, the JOLTS report, also on Wednesday. The ISM Manufacturing Index, the ADP employment report. Thursday, we have factory orders and jobless claims. Friday, we have the employment situation and the ISM Services Index. Companies reporting earnings this week are today we have Principal Financial Group. Tuesday we have AMD, Pfizer, Caterpillar, General Motors, McDonald's, I'm loving it, Amgen, United Parcel Services, and Stryker Corporation. Wednesday we have Thermo Fisher Scientific, Humana, T-Mobile. Thursday we have Apple, Amazon, Ford, Alphabet, which is Google, Qualcomm, Bristol Myers, Merck, Eli Lilly, and Honeywell. Friday is Cigna and Regeneron Pharmaceuticals. All right, so that's the weekly update as far as news from last week and news ahead. Certainly good news out there. Let's go ahead and read through today's market recap and see what they had to say about what's going on in the world. The S&P 500 dropped on Monday as investors were wary of making bullish investments ahead of the Federal Reserve's decision and further quarterly earnings from big tech companies this week. The Federal Reserve begins its two-day meeting on Tuesday and is expected to raise interest rates by 25 basis points, but investors are looking for signals from Chairman Jerome Powell on more hikes in the future and to dispel any expectations of rate cuts later this year. Yeah, a lot of people, again, I've been pointing this out for probably close to a year now. As soon as they started cutting rates back in, March of last year, they were already talking about, when we're going to start seeing rates go back up or go down again. It's like, we haven't even put the fire out. Y'all are already talking about, spending your vacation in Hawaii. It's totally nuts out there. All right, where were we? Technology was the biggest underperformer as most big tech companies are set to report earnings this week, with Meta Platforms, Alphabet, Apple, and Amazon.com reporting this Thursday. Apple, which is up 14% year to date, is expected to have benefited from a weaker dollar and an easing supply chain. But iPhone revenue may have been impacted by production challenges in China. Chip stocks and energy stocks also contributed to the market sell-off. The former was hit by weak sentiment following disappointing results from Intel, and the latter was affected by falling oil prices and strong Russian oil exports. Ford Motor Company dropped 1% on worries of waning demand after cutting prices of its electric vehicles. Yeah, I wouldn't buy one of those things. They're garbage. But that's just my own personal opinion. I'm not a fan of them. They just don't work for what I do. And, the big push to, move everyone to electric to me is just kind of a fool's errand, to quote he's not really my friend, but someone I follow, Scott Horton. He wrote a book about fool's errand. I suggest you go out and read it. It's pretty good. All right, next up on the docket, oil falls 2% as rate hikes loom and Russian flows stay strong. Ooh, that doesn't sound good. So let's go ahead and read through my synopsis of this. Oil prices dipped 2% on Monday due to a combination of factors, including a looming increase in interest rates by major central banks, strong Russian exports, and cautious traders. Investors expect the U.S. Federal Reserve to raise interest rates by 25 basis points on Wednesday, followed by a half-point increases by the Bank of England and European Central Bank. Brent futures for March delivery fell 2.3% to $84.90 a barrel. And U.S. crude futures fell 2.23% to $77.90 a barrel. The market is also under pressure from indications of strong Russian supply, despite the European Union ban and G7 price cap imposed after its invasion of Ukraine. Yeah, those awful Ruskies. The U.S. and NATO had no part in what happened with Russia or with Ukraine over the last decade. Yeah, none at all. Oh, wait, we did help with a coup in 2014, and Victoria Nuland was a big part of that. But yeah, that's just, that's nothing. Anyways, where was I? A gathering of key ministers from OPEC+, OPEC and its allies led by Russia on Wednesday will also be in focus. The OPEC+ meeting is unlikely to change its output policy, but PVM said it could, quote, surprise markets with a small cut, end quote. All right, so that's everything from that article. So like I said, oil prices, they've kind of just been in this state of, they kind of dropped for a little bit, like U.S. crude, or Brent and WTI, which is U.S. crude, had dropped down towards the low 70s a while back. It's now up in the high 70s, had gone over 80. It was going over $80 a barrel a few times in the last few weeks. So, again, some people I read say, hey, oil prices are going to go way back up, to $130, $140 a barrel. Others say it's going to stay where it's at. So, I'm not totally sure, if I were to place a bet with everything that's going on out there, I'd probably say oil prices are probably, there's probably a little more upside there, at least until the economy bottoms out. Once, we have, the bear market really takes hold and recession is really, taking over the economy here domestically, then I really see oil prices really start to bottom out at that point. But right now, especially with China coming out of COVID lockdowns and everything that they've done over the last couple of months, I think that, there's going to be a lot of upward pressure on energy prices, at least for the short term. Long term, I'm not totally sure. All right. Got one more article here to cover. It comes from our friends at First Trust, Brian Westbury, their chief economist. His Monday article is titled Debt Limit Drama. So let's breeze through that and see what he had to say. All right. The U.S. federal budget is on an unsustainable path, but not for reasons most people think. The national debt and budget deficit are a concern, but the real issue is government overspending. If the government spent less, even with high debt, the private sector could produce their way out of the problem. Excessive spending leads to economic problems, and interest on the national debt will likely continue to rise. The current debt limit debate in Washington is important as it can shine a light on overspending. A last-minute budget deal could include caps on discretionary spending, a commission to reform entitlements, or both, as part of a bipartisan agreement to raise the debt ceiling. Anytime that's bipartisan, the taxpayer and the American people are going to get screwed because the left and the right never agree on anything except spending our money. They're very generous with money that they don't earn. Let's see here. A last-minute budget deal could include... Oh, yeah, I already read that part. If the debt limit is not raised, the Treasury Department will prioritize payments to Social Security, Medicare, and Medicaid, while other programs face cuts. Oh, my God. What will those government employees do without their fake jobs? Ultimately, the current debt problem is not like past debt problems, as it is due to politicians spending to win favor with constituents. The debt ceiling can be used to focus attention on overspending and break this habit. Again, if you think that's going to happen, again, I got a bridge to sell you somewhere, probably over a lot of sand. But really the worst of it is, politicians, both sides are guilty of this. But politicians use my money and, taxpayers in the private sector to bribe, government employees and the wards of the state. And I consider those two in the same group. If you work for the government, you're a ward of the state, just like a welfare recipient. You might go and pick up trash or, sweep the floors or, do some math calculations for, some contractor. But again, you're still on government welfare. All these smart people who work for the government. I mean, imagine how much more productive our economy and our country would be if we didn't have millions of people in do-nothing government jobs, and we had those smart people in the private sector, making our economy better, smarter, and more productive. But hey, oops, sorry, hit the mic. No one listens to me. I'm just some guy sitting here in the mountains for the time being. So, alrighty. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. If you need to build a plan to, retire on time or retire when you want, get your kids educated, I wouldn't recommend college. Trade school is probably a lot better. But hey, if you want to waste your money and send your kids off to a 4-year university and, have them come back woke and with blue hair and rings in their nose and ears and stuff, feel free. I mean, not that I'm picking on people with earrings. I have a hole in my ear here from back in my young days and when I was a pirate in the Navy, but haven't really worn it since I got a real job. Anyways, all right. Well, like I said, that's everything I had. If you need anything from me, please go to the website. Otherwise, I will talk to you guys next time. Have a good one. Bye-bye.